Hello, my name is David Shu and I'm a current freshman at Carnegie Mellon University. Today I will explain why I believe that H&M is a better investment opportunity than its competitor Inditex. My hypothesis is that H&M is undervalued due to catalysts that the market has not accounted for, while Inditex has become overvalued by excessive growth. Looking at their multiples, we can see that H&M is underpriced, with a PD ratio far below the industry average and a PB ratio that is approaching it. Inditex, however, is overpriced with both its PE and PB ratio above the industry average. Moving on to the relative wealth charts, the first thing to note is that Inditex has been slowing down. Its margins and asset turns have both been declining, implying a decrease in ROGI, and thus CFROI. Its asset growth has been declining even though its CFROI is above its cost of capital. Usually in this case, strong companies focus on asset growth, but Inditex has not. This weakening performance is not reflected in its return or price charts, indicating that it is overvalued. H&M, on the other hand, has been undervalued. It has always maintained steady asset growth above 10%, and the only anomaly was in 2011, caused by pressures in the European market, which H&M did quickly recover from. However, CFROI hasn't reflected this due to the declining margins, which have been suppressing ROGI. This margin decrease is caused by the costs incurred by H&M's new investment strategy, which began in 2011. This leads me to my first catalyst, expansion. Up until 2011, H&M had been suffering from shifts in consumer taste and higher saturation in the European market. And unlike Inditex, H&M did not have a large international presence to counter its decline in Europe. At that time, it had only half the presence of Inditex, and since then has pushed for rapid expansion. Last year, it expanded into 3 new markets with plans to enter 5 more in 2017. Inditex, however, has slowed down. And since 2011, H&M has entered 23 new markets, while Inditex had only entered 11. In the past years, H&M has also diversified its brands, catering to multiple consumer tastes. Though Inditex owns many brands as well, the majority of its revenue comes only from Zara. In addition, H&M has surpassed Inditex in online presence, with services in 35 markets and 9 more coming in 2017. With the rising popularity of e-commerce, H&M sales can be expected to rise. H&M's recent momentum slump brings me to my second catalyst, the strengthening of the US dollar. Unlike Inditex, H&M is supplied by Asian manufacturers and pays with the dollar. Thus, it's exposed to the dollar to krona exchange rates. The US dollar experienced a sharp rally all throughout 2016, causing costs to spike for H&M. However, rates have begun to drop, implying future growth and higher future performance. Neither catalyst has been priced into the market, implying H&M is undervalued. Inditex had high success before, but has seen weakening performance, and the HOLT measurements support both of these claims. Thus, I conclude that H&M is the better investment opportunity and will outperform in the future.